Have you ever wondered how Warren Buffett became one of the richest and most successful investors in the world? What are the secrets behind his remarkable achievements and his legendary wisdom? How can you learn from his experience and apply his principles to your own investing goals? If you are interested in finding out the answers to these questions, then you are in the right place. In this video, I will share with you 10 investing tips from Warren Buffett that can help you improve your financial skills and grow your wealth over time. These tips are based on Buffett's own words and actions, and they cover topics such as risk, value, quality, patience, and more. By following these tips, you will be able to adopt a long-term mindset, a margin of safety, and a circle of competence that will make you a better investor. So let's get started and learn from the master himself. One, know what you are investing in. Don't put your money into something you don't understand. You should be familiar with the product, the company, and the industry you are investing in. You should know the risks and rewards of your investment. Making no decision is better than making a bad decision. Warren Buffett never invested in Microsoft, even though he was friends with Bill Gates. He wanted to show that he stayed within his area of expertise. 2. Spread your risk and focus your effort. You may have heard the saying, don't put all your eggs in one basket. Warren Buffett agrees with this. Having a portfolio with only a few stocks or sectors is too risky and unstable. By diversifying across different sectors, you can reduce your risk and enjoy steady returns over time. But you should also not waste your time looking for every possible opportunity. Warren Buffett's firm, Berkshire Hathaway, usually keeps what it owns and avoids missing out on great opportunities. He believes that it's far better to be approximately right than precisely wrong. 3. Wait for the long-term results. Successful investing requires patience and discipline. Warren Buffett thinks that investors should stay in the stock market, even when it goes down, because it can pay off in the long run. The financial success of a stock is not measured by one day or 1 year, but by the long term. Markets change, and if you move your money because of a short-term problem, you may lose more in the long run. The smart way to succeed is to buy when markets are low and hold your investment. As Buffett says, forget about the talk shows. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. 4. Look at the business, not the stock. The fundamentals of a stock are important, but they are not enough. Investors should also look at the quality of the business behind the stock. Warren Buffett thinks that investors should invest in good businesses that are well managed and have strong growth potential, and not just the stock of the company. The stock market reflects the ability of a business to grow and make money. 5. Trust your own judgment. Before making any financial decisions, Warren Buffett advises investors to take their time to evaluate the investment and collect all the information they need. Reading annual reports is much better than relying on tips, TV shows, or other people's opinions. An investor should be able to think for themselves and judge their investments without feeling pressured to make any quick decisions. 6. Have a margin of safety. The most important part of investing, according to Warren Buffett, is the margin of safety. This means the difference between the value of the stock and the price you pay for it. Even if you do your research and find a stock that seems very attractive, you should always look for more information. When buying the stock, you should have a margin of safety, that is, a belief that the stock is worth more than the price you pay for it. 7. Stay away from day trading. Day trading is an expensive habit. Warren Buffett says that trading in and out of stocks is not in the best interest of most investors. It costs a lot of time and money to watch stocks every day. It is not efficient and can be costly over time. Instead, focus on investing and try to get the best return over several years, rather than trying to beat the market in 1 year. 8. Quality matters more than price. The value of a stock is important, but investors should also look at the strength of the company behind it. A great company with a reasonable price is better than a mediocre company with a cheap price. Warren Buffett changed his mind on this old Benjamin Graham idea thanks to Charlie Munger, and that led to some of his biggest wins. For example, one of his best investments is probably Apple. The reason is simple. Apple was a great company with a fair price, which eventually gave him huge returns. Warren Buffett recommends investing in quality companies and businesses that have a long-term vision and reliable management that can perform even in tough times. 9. Buy low, sell high. The market is unpredictable, and it will rise and fall. This is a chance to buy cheaply when stock prices are low and sell expensive when they are high. If someone sells, it means they are scared, which should alert the investor that there might be a good opportunity. Likewise, if stocks go up out of fear, it is time to be careful and/or check your portfolio to avoid losses. Value investors like Warren Buffett use this cycle to make good returns. 10. Don't chase every opportunity. Warren Buffett often goes to speeches and investment events where he emphasizes the importance of not investing in anything just to get a return. Investing means letting your money work for you for a long time until you can enjoy your profits. Smart investing means investing wisely and carefully. Warren Buffett advises you to take your time and use each opportunity well, especially when you have done good research. The saying, "you don't need to swing on every pitch," means that you don't need to take every tempting opportunity without good judgment. A good investor can skip many opportunities, but what matters is the quality of those they invest in. I hope you have enjoyed this video and learned something valuable from it. Warren Buffett is not only a great investor, but also a great teacher and a great role model. By following his advice, you can improve your financial literacy, your decision-making, and your confidence. Remember, investing is not a game of luck, but a game of skill. And the more you practice, the better you get. So, don't be afraid to take action, learn from your mistakes, and keep growing. Thank you for listening, and happy investing.